Welcome to the Commercial Real Estate Show. I'm Michael Ball. Thanks for being with us. We are your source for commercial real estate, market intelligence, forecasts, and strategies. And we have a fantastic show for you today. We have Ryan Severino with us. He's a senior economist with Reis. He's come down from New York to see us in Studio One. Ryan, thanks for being with us.
My pleasure, Michael. Always good to see you, especially to get to come down to the sunny climes down here in Atlanta and get away from New York for a little bit.
Yeah, it is a beautiful day today. And Ryan, one of the things that seems to be on the mind of readers and listeners and viewers today is, I don't know, where are we, in the cycle? Some people seem to be a little nervous about it, wondering what's going to happen, how long the good times are going to roll. It certainly has been good times. So where are we? How long will the good times last?
I feel pretty confident that we still have some room to run thus far. I think context is important. I think people look at where we are in the cycle and think, okay, the economic recovery / expansion is more than 6.5 years old at this point. It's closely approaching 7 years. And I think by conventional standards, that is a relatively long period of time. But I think the thing that characterizes this recovery period from the recession that we went through is that it is a little bit different. We don't often go through the kinds of balance sheet recessions like the one that we went through. And the empirical research is pretty good in that it shows that when you go through these recessions, the recovery is shallower on a per annum basis, but the cycle tends to be a little bit longer. And so I think if you look at this kind of recovery, that's kind of what we've gotten. We've gotten weaker GDP growth on a per year basis than we had really seen for most of the post-war era, certainly in some of the boom years.
It's been a slow recovery, hasn't it?
Very slow. 2 to 2.5% is not anemic, but certainly relative to what I think most people have gotten used to in the latter half of the 20th century, it's certainly different. So that feels about right to me. And then if you look at those kinds of recoveries, they tend to be a little bit longer. And so I think if you look at the major economic indicators, what's going on with economic fundamentals, and sort of differentiate between what we're seeing in the markets and what we're seeing in the economy still looks pretty solid. The labor market continues to create a good, solid number of jobs. You're starting to see, somewhat better data on wages, even though they're still muted by historical standards. If you look at industrial production, if you look at capacity utilization, if you look at the yield curve, if you look at the expansion of the service sector, if you look at the expansion of the industrial sector, excluding, mining, basically excluding energy, oil, all of those things still look pretty good. So I still think we probably have a couple of years or so before we have to start to think about, are we nearing the end of the cycle? Because most of the indicators are really saying, this is kind of a mid to late stage expansion that we're still in. And I don't think there's anything that really intimates that we're on the precipice of a recession, knocking on the door anytime soon.
Yeah, and that's interesting because I think some people are in the camp that they're just very nervous and think the tables are really going to turn negative here now in 2016. But then we have some sellers out there of properties that the market is so hot they're not even coming to terms with buyers in this market, thinking that it's going to go on forever. And what are some of the other reasons why it's different? This time, is one of the examples the amount of debt that we have on our real estate today compared to the last fall?
Yeah, honestly, I think that is an important differentiating characteristic. I think a lot of people think that, prices have certainly appreciated, no doubt about it. Property values are hot, but I think if you look at the level of debt, it's not like it was before the last downturn. If you look at the fundamentals and the underwriting assumptions that people are using, I'm not saying that people aren't getting more aggressive over time, but it's not incongruent with what we're actually seeing in terms of the evolution of fundamentals in most property types. I think if you went back to the last cycle, you would have seen what I've often called wildly aspirational underwriting assumptions. And I'm not saying
what
don't
vacancy,
see that.
What reserves?
Right. I mean, double-digit sequential, rent growth for years and years and years and years.
Yeah.
The probability of that occurring was so low, and yet so many people were using it. I think there's more discipline in the market today relative to what we were seeing before. So I think, it's the combination of the economy still growing, the combination that fundamentals are not showing that they're peaking just yet, and that the capital markets, while clearly, again, pricing is robust, it's not really sort of an overheating excess leverage type situation, at least not yet. I mean, I never rule out that possibility, but really not yet. I mean, if you look at most of the major indicators, it still looks pretty good out there.
Yeah. And you mentioned jobs. So what about the job market? It seems like the companies that we represent in their office space are really concerned about recruiting and retention, and it seems like the job market's really tightened up for a lot of industries. Do you think the job market can continue to grow? Of course, that's going to help commercial real estate if it does, right?
Yeah, I think so. I mean, even if it's hard for us to replicate what happened in 2014 when the labor market was incredibly robust. This year most people thought we got off to kind of a slow start, and then the January number was revised upward, and February number was actually really robust. And so I think even, again, we're almost 7 years into this, we're still seeing a labor market that on average, using a reasonable interval, 6-12 months, is still generating more than 200,000 jobs per month. And I think, knock wood, barring some kind of idiosyncratic shock, even if the absolute number of jobs per month starts to moderate over time, I still think that there's some gas left in the tank here, that we can see the economy to continue to create jobs, to pull people who are either out of the labor force or marginally attached to the labor force back in. That will, you've seen the decline in the unemployment rate start to slow as we've attracted people back in. But I mean, even, the participation rate has started to move up, and people were really sort of downtrodden about that because it hit levels that we haven't really seen in a few decades. We've even seen some stabilization there, and so I think you're really starting to see not just the sort of well-entrenched members of the labor force starting to fare better, but I think even some of those marginally attached participants, somebody who was part-time transitioning to full-time, someone who wasn't working at all transitioning to working. I think you will continue to see that persist at least through the balance of this year into next year.
Well, that's good news. And we're talking with Ryan Severino, a senior economist with Reis, and Reis tracks the commercial real estate market, pretty much every sector throughout North America, and you guys do a good job of that. And Ryan, what about the people who are suggesting that some buyers may be overpaying in this market? I mean, we're seeing some extremely low cap rates, especially in some of the gateway markets for core assets. What do you say to those people when they mention bubble pricing?
I think there are pockets here and there where you could say things are getting a little bit frothy, but in aggregate, I think if you look at where we are in the market today, cap rates today are fairly similar to what we saw at the peak in 2007-ish, 2008, before the bottom really dropped out of the market. And I think that's why a lot of people they're looking at that as a basis of comparison, and they're saying, oh, here it goes, we're back in another bubble. But I think it's important to differentiate between the components that drove the cap rates so low then and the components that drove the cap rates so low now. Then it was, I'll call it the risk premium, right? The cap rate spread was too low. Because people forget Treasury rates, we'll use the 10-year Treasury because that's really sort of the benchmark for real estate, were about 200 basis points higher than they are now. So where did that low cap rate come from? It came from that compressed risk premium that people were just overpaying. They were discounting how much risk was in the properties, and I think what happened in 2008 and 2009 clearly bears that out. If you look at the situation today, the cap rates are low because the interest rates are low. The risk premium that's embedded in real estate deals is still pretty wide. It's about a couple hundred basis points wider than it was before the bubble burst, to which people usually want to throw the Fed under the bus and say, well, interest rates are only low because the Fed's holding them down. To which I say, the Fed really only has control on a short-term basis and really only nominal rates. The real interest rate in the economy is primarily determined by economic growth. And we were just talking about how it's been weaker now than what we've seen historically. So that tells me that the cap rates are probably congruent with the economic environment that we're in. But you can't make that case in 2007 and 2008, where you would probably argue that the risk premiums were a little too narrow.
Yeah, and we're certainly seeing a lot of demand from domestic buyers of all types and foreign investors in the U.S. So we had the FERPTA changes, which, is that going to create more demand for commercial real estate and maybe keep cap rates low?
Yeah, I think all else being equal, we are the harbor in the tempest, whether it's foreign investors, U.S. investors. It can be a double-edged sword, but one edge of that sword is that when there's disruptions in the global economy and markets elsewhere in the world, you see money come funneling back into the U.S., into treasuries, into commercial real estate. And so I think it looks good from the macroeconomy point of view, it looks good from fundamentals, and it also looks good from sort of a capital flow point of view. So yeah, I think even as interest rates rise, as long as those things stay in place, you'll see relatively low cap rates at least for the foreseeable future.
Yeah, because I guess people are seeing real estate in the U.S. as kind of a safe haven, right?
Absolutely. I mean, it's much safer than just about anywhere else in the world.
Yeah.
I mean, even some of the boom countries are slowing a bit these days.
Yeah. Well, it's interesting when you start seeing people at parties again start talking about buying condos and properties in New York and Miami to
and
flip
Vegas.
Yeah. It's like,
Yeah,
didn't we hear this in 06 or 07?
No. When your taxi cab driver is telling you that he owns 7 condos,
You're in trouble.
take it with a grain of salt.
Well, stay tuned. We'll have more from Ryan Severino with Reis on real estate. I'm Michael Bull. Hey, next we're going to talk about the impact of rising rates on commercial real estate. Stay with us. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. We're talking with Ryan Severino, senior economist with Reis, about the commercial real estate market and what to expect moving forward. And Ryan, I think one of the questions on listeners' minds today is, I guess we hope that interest rates are going to go up, right? That the economy continues to prove that they're going to go up. Well, how will that impact commercial real estate values and cap rates, do you think, moving forward over the next several years?
Here's what's interesting. It's almost in the way that you asked the question or led into the question, because you're right. We generally do want to be rooting for rising interest rates because it's a reflection on the economy. If interest rates aren't rising, it probably says something not so great about the economy. Yeah. And in there contains a lot of useful information, because I think the average person has a tendency to think that when interest rates are going to go up, cap rates are going to go up. And that's only true if you think that the risk premium, the cap rate spread, whatever you want to call it, is either fixed or it's also positively correlated with the economy. And that doesn't really make any sense, right? That risk premium should compress as the economy gets better, because as the economy gets better, all the while interest rates going up, fundamentals get better, NOI growth starts to accelerate. Any rational investor is going to pay more for a property with accelerating income growth than one that has flat to declining income growth. And the risk perception of those assets is going to diminish, because it's like any other sort of risk-tolerant asset class. Its fortunes are better along with the overall economy getting better. So investors are willing to sort of pay up a little bit more because they know there isn't as much risk in a rising economic environment than a falling economic environment.
Right, and of course they're not buying, the cap rate is suggesting really your first year's return, and
right.
They're not buying it for 1 year's return
exactly.
Anyway.
So
right.
I think that's where people sort of, not that interest rates aren't an important factor. I mean, clearly we were just discussing that, but they don't operate in a vacuum. The only way that you would have interest rates on their own putting upward pressure on cap rates is if that other component, the risk premium, like I said, was either fixed or also positively correlated, which we know through pretty good empirical research it isn't. So I think, short term, looking out the next couple of years, I'm not saying you're going to get cap rate compression like we have been seeing during this recovery, but it's hard to envision an environment, especially with so many people perceiving the risk to real estate in the US, like we were mentioning, being relatively low and still putting money here in the US, to really see that kind of dynamic swing the other way. Eventually it will, and I'm a big believer, and I think it's not hard to see this in the data. Economics and real estate, these are cyclical things, and at some point we will be in a rising cap rate environment, probably at the time when fundamentals sort of peak and then they start to move a little bit past peak, all the while interest rates are still rising because the economy still looks good, and then you lose the downward pressure on cap rates that you're getting from the improving fundamentals and the compressing risk premium while interest rates are going up. That's a recipe for cap rates to start rising again, and it usually leads into a recession.
Right. Okay. So my question for you then is, when does that happen? Right. Look in the crystal ball here at the Commercial Real Estate Show desk.
I'm going to use the dark side.
When does it happen? I mean, how long until that happens? I mean, I guess it depends on interest rates and a lot of things, but what would be your estimate?
Yeah, I'd say we probably have a couple years, 2-3 years, somewhere in that time frame. Because again, thinking that we're 7 years into this recovery, that puts us kind of 9 to 10 years out. That's really long compared to historical expansion cycles in the U.S. The longest one is really the 90s .com expansion, and that's going to be very difficult for us to sort of replicate. It's not impossible, and there's a lot of good research that says recoveries don't die of old age, which basically means just because the recovery is getting older doesn't mean that it's going to have to end soon because it's 10 years old or 11 years old. But it's like anything else. It's the law of compounding. The bigger something gets and the more you have to compound, the harder it is to sustain that. And so I think by the time we get out over the next 2-3 years, if we haven't started to see those signs show up, I'd start to think more critically about it. I'm not explicitly calling for a recession, but again, it's a cyclical thing. At some point in that sort of high single-digit, low double-digit number of years of this economy expanding, we're going to have to start to face the realization that a recession is going to come sooner or later.
Yeah, I mean, how much will it impact commercial real estate this time if it's not really real estate based? I mean, we've had a very lackluster level of new construction and new supply, right? We have a lot lower debt. So is that going to help us? And then we also have rising labor costs and construction costs that seem to be, again, maybe limiting new supply. So if we do hit a recession in 2 or 3 years that's not real estate based, is real estate kind of a safe bet?
It's safer than a lot of other parts of the economy and the asset marketplace, if you will. I think if you look at the last 2 or 3, real recessions in the U.S. that impacted real estate. The dot-com one barely impacted real estate, as I think everybody knows. But if you look at what happened sort of the late 80s into early 90s with the wake of the savings and loan crisis, that was a supply side problem, right? You change tax laws, everybody wants to build, all of a sudden you have an oversupply situation. You have a whole bunch of, they call them see-through buildings because they never got leased up. That was a bad problem.
Yeah.
In 2008, it was not so much a supply side issue, it was a demand side issue, and that when you see the economy contract that much, you lose 8.5 million jobs, it's going to show up in real estate, whether or not real estate, the whole debt issue notwithstanding, it's going to show up in real estate. This time around, you're right, we don't have the supply issue the way that we had in the early 90s, and we're probably not going to see the kind of big hole punched in aggregate demand that we saw during the last downturn, because honestly, those kinds of recessions only occur every so often, to use a technical economic term, because it takes a while for those imbalances to build. You have to have a lot of people doing a lot of stupid things over a relatively long period of time to get that to happen. So when the next recession comes, it will be shorter and shallower than the one that we just went through. So I'm not saying it won't show up in the real estate market at all, but it won't be anything like the one that we just saw, which was, clearly the worst recession since the Great Depression in the 30s. So, I don't want to see that again in my lifetime.
No.
Once is enough. It was an interesting experience, and I say that without connotation. Just interesting, especially as a research geek.
Yeah.
But I have no desire to see that again in my lifetime.
And you mentioned that you're not seeing stupid investors and building going on, and it seems like the lenders are really cautious. We had Brian Bailey on the show with the Fed, and it seemed like they were kind of indicating to lenders to be a little cautious in their underwriting, especially I guess with multifamily. And it seems like the lenders, if the debt is cautious, that's also going to help.
I agree, and I think there has been more restraint. I think the last time around was a little bit of an anomaly, right? It was almost the perfect storm. We came out of the dot-com recession, so nobody wanted to touch equities because they were tainted. Bond yields had fallen to, at least at that time, what were really cyclical low levels, and so in the prospect of rising interest rates, nobody wanted to touch the bond market. And then it was as if people forgot that real estate existed. Like, hey, there's all this stuff and it has attractive yields, and it's a hard physical asset, so there's an element of security there if anything happens, and people went piling in. And so clearly that had really deleterious impacts on this time around. Again, values are up, but we haven't seen the excessive use of debt. If you look at nominal debt relative to nominal GDP, we're still at a low. We're probably about 4.5 points below where the peak level was, which means the economy can probably grow for another 6-7 years before we can even start to approach that level again. At that point, if real estate values increase and we start to get debt growing faster than that, then maybe over like a 6-7 year period, we can start to nudge back toward that. But like we were just talking about, there might be a better chance that we hit the next recession before we get back to that peak level of commercial real estate debt to GDP.
Yeah. Well, those are good points, and I think there's a lot of reasons that it is a little different. But I think we're all nervous, right? That last downturn was so bad that everybody's kind of shaking in their boots and maybe being overcautious. Well, stay tuned. We're going to have more from Ryan Severino. Next, we're going to talk about some of the sectors, some opportunities in the sectors, and some factors that may impact the various commercial real estate sectors. So stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by CCIM Institute, Commercial Real Estate's global standard for professional achievement. Visit ccim.com/CRE show. That's ccim.com/CRE show. Welcome back to the Commercial Real Estate Show. I'm Michael Ball. Today our show topic is called Reis on Real Estate. We have Ryan Severino here, senior economist with Reis, and we're talking about commercial real estate forecasts. And one of the sectors that I think people are somehow a little concerned with is because it's had such a great rise and such great performance is the multifamily market. Some people think maybe we're overbuilding in some markets, but it seems like the apartment market just continues to do well. I mean, what do you see for the apartment market?
Yeah, I think it has been kind of the darling of commercial real estate for the last 5-6 years. I think rather than extolling its virtues, I think there is a little bit of concern out there on the part of supply growth. And I think a little bit of concern is probably the right way to characterize it. This is not turning into a massive overbuilding situation. It's not a deluge. We're not drinking from the proverbial fire hose, but it's definitely different than what we've seen over the last 4 to 5 years. The last 4 to 5 years, we've been the big beneficiaries of increasing demand while the supply pipeline had to catch up because we weren't really building anything when the market started to recover because of that whole, that little credit crisis thing that was going on. Then we started to play catch up, and now we're starting to run ahead of demand a little bit. But that said, proper context, vacancy is still incredibly low nationally. It's only going to drift marginally higher. So I think you'll see signs at the margin. There are some pockets of overbuilding, certain markets, certain submarkets, but by and large, even as vacancy starts to drift higher, I think you will still see the apartment market be in a low vacancy rate environment over the next 4 to 5 years. I try not to look into the crystal ball beyond that, but it will still stay a very strong property type even over that interval. I think people just have to recalibrate their expectations a little bit because it has been so good for the last 5 or 6 years. I mean, it's been the perfect storm in many respects, and I think it will still be a favorable environment going forward, just not as easy as it's been over this recovery, which really dates back to early 2010.
And there seems like there's been a lot of factors that have been creating that demand for multifamily from the tenant side. Do you expect that high demand to continue as the millennials still going to lease this many apartments, or are some of them going to start buying houses, or what?
I'm a big believer, and I think the data kind of bears this out, that most people make the rent versus own decision based on sort of economics where they are in their life and not just the relative economics of rent versus owning. And millennials are still a pretty young generation. The big bulk of them are still sort of 23, 24, and 22. And so they have a ways to go before they think about settling down, getting married, starting a family. That's really when you see the transition to home ownership. The two big drivers of transitioning from renting to home owning are getting married and having your first child. And if you're early 20s, most people in their early 20s aren't thinking about those things, especially millennials. They're very transient. They move around for job opportunities more than older generations. They're willing to go to graduate school in a way that we have never really seen before in historical generations. It doesn't make sense for them to be tethered to a condo or a mortgage. And so I would expect them to make that transition, but I think we have years before we really start to see that transition in bulk. The older tranches of the millennials are making that transition, but they're in front of a big bulk of them that still have a ways to go before they start to think about that proposition.
Okay. And where do you see opportunities in the multifamily market? Is it in new supply in some of the underserved markets, or is it in buying B communities? What are some opportunities?
I'll tell you my two favorite places to play, which if you think about a Venn diagram, they kind of overlap a little bit. One is BC, because we just don't build it. And if anything, the inventory starts to deplete over time because there are more conversions and demolitions, or just people buy one and CapEx it back up to Class A. Then you have sort of attrition from Class A down into BC. So I like that BC space. You can't push rents as easily as you can in the Class A space, but the tenancy is very durable. Vacancy rates are incredibly low relative to A, relative to historical standards. And I think especially if you're opportunistic about deals, you find the ones where you can slap on a new coat of paint or make some minor changes and you can juice the rents a little bit. I think there's a lot of value to be found there, especially in really small property types below the institutional radar screen. that other part of the Venn diagram, I think suburbs are being overlooked. I think people have this tendency to think, oh, the suburbs are dead and they're never coming back. And I think there's some truth in sort of the suburbs versus CBDs thing, but more people live in the suburbs than live in the CBDs. More people work in the suburbs than work in the CBDs. And I think it is being neglected a little bit. I'm not saying there's no construction out there, but relative to inventory, you're definitely seeing more concentration in the CBDs than you're seeing out in the suburbs.
Any markets or cities that do you like for opportunities?
You know, I like the growth markets, especially if you're talking about BC. So, you know, the growth markets in Texas and other parts of the Southeast and Southwest. I think, you know, you have people who are working, they're not making, not to be crass about it, but they're, you know, they can't afford a Class A, they can't afford home ownership right now, and those populations keep swelling. If you
Why are you so mean to me? I'm trying to make more money.
If you look at I'm sorry, I didn't mean to throw you under the bus there, but if you look at the populations in those cities, you know, Dallas, Fort Worth, Houston, Austin, Atlanta, places like that, markets are still growing. It's a good sign for BC apartments.
Okay, good. Well, after a short break, we're going to talk about retail and the office market, and we may get to industrial. Stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking with Ryan Severino, Senior Economist with Reis, and we're talking about commercial real estate. One of the sectors that I think a lot of people are concerned about is retail. You know, we have online sales, we have a lot of store closures that were announced in January, but yet some retail seems to be doing really well. What do you think about the retail sector?
Yeah, I think retail is really interesting right now because it is a little bit of a mixed picture. You have some high end that's still doing pretty well, the low end that's kind of hanging in there, the middle of the market, I know as you and I have talked about before, still kind of looking for stability that it hasn't really found just yet. And I think you're starting to see those divergences play out in ways that people probably weren't even expecting. My favorite one is you think about Sports Authority just announced, you know, bankruptcy and closing stores. And then you look at someone like Dick's Sporting Goods, who's been expanding their footprint and growing their market base. And I think that's really sort of this contrast. Going to Sports Authority is almost like going to buy sporting goods at an airplane hangar, right? It's sort of bare bones. It doesn't have a warm and fuzzy feeling. It's kind of antiseptic. You go into Dick's, and Dick's has a little more of a high-end feel to it. The finish is a little bit nicer. It feels a little more welcoming, and it's sort of the high-end versus low-end kind of dichotomy that we've seen in some ways. So I think that's still playing out, even as the rising high tide of the economy and the labor market help. It's only going to help so much. To your point about e-commerce, I think what you're starting to see now is that as e-commerce continues to grow, we're realizing that e-commerce and bricks and mortar are a little more complementary than competitive in many respects, but that doesn't mean it's not going to be disruptive to certain retailers who are going to be closing certain underperforming stores and keeping the ones that they feel like are actually viable. The big concern, if you went back over the last, 5-10 years at least, was that you're going to see bricks and mortar retailers imperiled by the showrooming concept, right? Where consumers were going to come in, take a look at the goods, and then go home and buy them online. What you've also seen is that there's the reverse, which is called web rooming. I don't know if you've heard about this, but people will actually look at goods online and then they'll go into the stores and they'll feel them and they'll play with them a little bit. And then it actually is kind of a synergistic, not to be buzzworthy, but a little bit of a synergistic relationship, which is why you're seeing some e-tailers now looking forward to opening up bricks and mortar stores somewhere. So consumers can do that, so it's easier for them to have returns. And so I think it's becoming a little more synergistic. And then the other thing about retail, which is really happening, is that the whole experiential retail concept, which has become really in vogue these days, retail is kind of going through a transition, I feel like, from just sort of the old perfunctory, I have to go get jeans, so I'm going to run into Macy's or Banana Republic and get jeans and then go back in my car and drive home, to this kind of hybrid sort of work, eat, play entertainment complex, which is why I think you've seen the rise of full service restaurants as opposed to food courts, and movie theaters, and entertainment venues like Dave & Buster's or something like that. You're seeing retail start to transition away from that just I have to buy stuff model to we can actually do other things in addition to maybe picking up some t-shirts or something like that, which is why I think you've seen lifestyle centers and town centers and even some of the higher end malls that have capitalized on this be the winners in this transition over the last 5-10 years.
Well, having said all that, and you guys look at the performance on the rental rates and the occupancy throughout the U.S., what are the trends telling you as far as the future of the performance in the multifamily sector?
You know, it's still really sort of a mixed speed recovery right now, depending upon what part of the market we're talking about. High-end stuff, still good times, very low vacancy rates, strong rent growth. It's clearly a landlord's market. Your kind of BC malls, that's where there's still a lot of concern because demand, as we talked about, hasn't really come back just yet. You're seeing some enterprising people buy some of these struggling malls and turn them into a mixed-use center or convert a mall into a town center. So I think there are some opportunities there. I think at the sort of more mundane neighborhood and community centers, I think you've seen the defensive ones hold up pretty well, the grocery-anchored centers versus the non-anchored centers. And then even power centers. You know, I know big box has certainly come under pressure, but power centers have had a pretty good run for the last 5-6 years. So I think it really is sort of a difference depending upon, you know, what part of the consumer spectrum you're targeting, what your specific subtype is, and do you have something to offer your consumers that can't easily be replicated online, like a dining experience, or you know, if you go to a big mall like the Mall of America and you have roller coasters and Ferris wheels and good restaurants and things like that, that is the incentive that is going to draw people in above and beyond just competing on price or something like that.
Yeah, well, that makes sense. So where do you see opportunities in retail?
You know, I really think that the rising high tide will raise most of the ships going forward. The one thing you have to watch out for are the centers where they're in a part of the country that's in more permanent decline. But, you know, and I know we've talked about this before, but it's a question of cap rates. And you see, oh, these are relatively high attractive cap rates. Okay, but why are they high? And I think there are some centers that are probably being beaten down a little too much because I think people are thinking, oh, this is a permanent kind of thing with the internet. And again, it's a little more complementary than purely competitive. And so I think there are some centers that will benefit as the economy continues to recover for the next few years and the labor market continues to recover. But I'll be the first person to concede it's kind of hard to know sometimes the difference between something that's declining on a more permanent basis and something that's going to start to rise again. But honestly, I also think these redevelopment opportunities, if you can buy a struggling mall and turn it into a successful town center or lifestyle center, I've seen those concepts perform incredibly well, but that's clearly a little more of a high risk, high reward kind of opportunity.
Yeah, very high risk. So you're bullish then on multifamily, and on retail you're lukewarm there? Or?
Yeah, you know, it's clearly the laggard in this recovery, so I still think it's got some room to run, but this is not your grandmother's retail market recovery. I mean, we are not going to get back to the vacancy rates that we saw last decade or even the decade before that, before the cycle turns. So you have to pick your spots very carefully in retail.
Yeah, that's a good point. And you know, we do a lot of shopping center sales, and you know, we're seeing the same thing. Some real low cap rate, really everybody wanting to buy them. We see some that are struggling and do have some opportunities. Well, stay tuned. We're going to talk about the office market and the industrial market. Stay tuned for more with Ryan Severino on the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by CCIM Institute, Commercial Real Estate's global standard for professional achievement. Visit ccim.com/CRE show. That's ccim.com/CRE show. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. We're talking with Ryan Severino, Senior Economist with Reis. And let's talk about office. What is your outlook for the office market?
You know, relatively optimistic. I think we're not going to see the kind of strength in the office market that we've seen in recoveries past, but I clearly think that we are seeing the tide starting to rise a little bit faster. In the fourth quarter of last year, we actually saw, it's not going to sound like much, but relative basis, 20 basis point compression in the national vacancy rate, which is really the first time since kind of the mid-2000s in the wake of the dot-com boom and bust that we've seen vacancy compress more than 10 basis points. So it's been a long time coming to get back to this point. And I think it portends better things because it's not just that the labor market is generating more jobs, but the quality of job over time is getting better. It's creating more office-using jobs than we've seen. So I'd expect to see vacancies fall probably another 200, 250 basis points before we even start to think about the cycle turning. And I think that would be a generally good outcome for most office markets across the country.
Yeah, well, that's good news. And it seems like the office landlords are doing the Snoopy dance, especially in where we're recording the show here in Atlanta. You know, we're seeing rental rate increases like we've never seen before. And you know, and some of the tenants are really getting rate shock, you know, when they go to do their renewal. So, well, let's talk about industrial. You know, it seems like industrial's been a very hot market. What do you expect there? What's your forecast?
Yeah, I'm not materially different from office. I feel sort of the same kind of optimism about the industrial market. I think it has had a good run for the last few years. You have started to see the supply pipeline swelling a little bit relative to what we were seeing just a few years ago. But I think there is a lot of demand out there between, you know, just sort of us importing things, and then you think about the economy continue to grow and sort of trade volumes starting to run up again, not growth that we've seen historically, but improvement in trade volumes certainly, especially as a big net importing country. You know, I think the great thing about industrials, it doesn't care if you're selling, you know, your stuffed animals online or in a, you know, in a Hallmark store somewhere, just as long as it needs to be stored somewhere temporarily. And I think the big development we've seen over the last, say, 12 to 18 months is that demand, which was once concentrated in very large centers, has now trickled down to smaller centers as a lot of tenants and potential tenants try to solve that last mile problem, right? If they're really trying to deliver goods, and it's become almost like this nuclear arms race. Oh, we have to get you your Furby in 6 hours or less, or whatever it is. You can't just shoehorn a big building that close to an urban center. So the way I've described it is almost like a constellation, right? You rent 3 or 4 smaller facilities that in aggregate total up to something larger, and then you just have good logistics software and systems that can kind of coordinate a little bit better, and all of those different centers are within a reasonable drive time to wherever you need to get the goods to go. And I think that's a good way to replicate a big center without having to pay for and develop a really big center. It's not a perfect solution to that problem, but it's certainly a solution to that problem.
Well, I want to get my teddy bear fast, you know. I get it. So opportunities in industrial?
I like that play. I like the smaller properties closer to urban centers. I think it's not early in this process, but it's far earlier in this process than people have jumped on the bigger centers. But that said, this is a widespread recovery. I think even in some of the smaller markets that are being overlooked, the Nashville's and Memphis's and Kansas City's of the world, we've seen a lot of strength in those markets, and I don't think the cycle's fully played out for some of those secondary markets just yet. So I don't think it's just sort of the big 6 distribution markets and everybody else the way it's more concentrated in office. I think this is a much more diffuse recovery in industrial, more akin to what we've seen in apartments up to this point.
And quick word on office opportunities, where are they?
You know, it's not for the faint of heart, but I think if you're out the risk-reward spectrum, the suburbs are being overlooked, and I'm not saying the suburbs are a layup and there's a huge rift between winners and losers, but the suburbs are not dead contrary to popular opinion. You just have to be really careful about picking your deals, because good deals can be home runs and bad deals you can go down swinging miserably. But I feel like the perception in the economy is that the suburbs are dead and the CBDs are ascendant, which I think is true, but it's not an absolute thing. There are still gradations within the suburbs.
Ryan, great information. Thanks for joining us.
Always my pleasure. Thanks for having me.
We appreciate it. And thanks for joining us out there on one of the radio stations, iTunes or YouTube. Join us next week when we're talking about adaptive reuse. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate asset and occupancy solutions. Visit bullrealty.com. CCIM Institute, commercial real estate's global standard for professional achievement. Visit ccim.com/CRE show. Excelligent, providing verified commercial real estate information across the United States. Visit excelligent.com.